Index funds, ETFs, mutual funds, hedge funds. They all sound the same, don't they? They're all funds, they all invest in stocks, so what's the actual difference? If you've ever been confused about which one to choose or what makes them different, you're not alone. This is one of the most confusing topics for beginners, but today I'm breaking down the differences between all four so clearly that you'll never be confused again. By the end of this video, you'll know exactly what each one is, how they work, who they're for, and which one makes sense for you. Let's dive in. Quick disclaimer before we get started. Everything I share on this channel is purely educational based on my 10+ years of investing experience in both stocks and crypto. I am not a licensed financial advisor, and this is not financial advice. Everyone's financial situation is unique and different, so always do your own research and consult with qualified financial professionals before making any investment decisions. Now, let's break down these four types of funds. Before we talk about what makes them different, let's start with what they have in common. All four of these, index funds, ETFs, mutual funds, and hedge funds, are types of investment funds. What does that mean? It means they're all pooled investments. Instead of buying individual stocks yourself, you're putting your money into a fund that holds a collection of different stocks, bonds, or other assets. Think of it like a basket filled with many different investments. That's what all four have in common. They're all baskets. But the difference is, that's where it gets interesting. Let's start with index funds. An index fund is a type of mutual fund that tracks a specific market index. Remember when we talked about indexes? The S&P 500, for example, is a list of the 500 biggest companies in America. An index fund simply copies that list exactly. If Apple is 5% of the S&P 500, then Apple will be 5% of the index fund. The fund doesn't try to beat the market or pick winners, it just mirrors the index. That's why it's called passive investing. Index funds trade once per day after the market closes. You place your order anytime during the day, but the transaction happens at the end of the day at one single price. Fees are usually very low, often under 0.2% per year. Example, VFIAX, Vanguard's S&P 500 index fund. Now, here's how index funds trade. Let's say you place an order to buy an index fund at 9:30 in the morning. Your order doesn't execute right away. It sits there waiting. Someone else places an order at 3 in the afternoon. Their order also waits. At 4 p.m. when the market closes, both orders execute at the exact same closing price. It doesn't matter if you ordered in the morning or afternoon, you both get the same price. That's because index funds only trade once per day at the closing price. This is different from ETFs, which we'll talk about next. Now let's talk about ETFs, or exchange-traded funds. ETFs are very similar to index funds in what they hold. Many ETFs also track indexes, like the S&P 500. So what's the difference? The difference is how they trade. ETFs trade on exchanges just like regular stocks. That means you can buy and sell them anytime during market hours, from 9:30 a.m. to 4 p.m. The price changes every second based on supply and demand. If you buy at 10 a.m., you get the price at 10 a.m. If you buy at 2 p.m., you get a different price. Unlike index funds that trade once per day, ETFs give you real-time pricing and instant execution. The fees are also typically even lower than index funds, often under 0.1%. Popular ETFs include VOO, SPY, and QQQ. For most beginners, ETFs are actually better than traditional index funds because of the lower fees and trading flexibility. So, index fund versus ETF, which should you choose? Here's the quick comparison. Index funds trade once daily at closing price. ETFs trade anytime during market hours at current market price. Index funds often have minimum investments of $1,000 to $3,000. ETFs, you just need enough for one share, which could be $50 to $500. Index fund fees are low at around 0.1 to 0.2%. ETF fees are even lower, often under 0.1%. For most beginners with small amounts to invest and who want flexibility, ETFs are usually the better choice. But remember, they often hold the same stocks, it's just a different wrapper.
Now, mutual funds, here's where it gets a bit confusing, because technically, index funds are a type of mutual fund. But when most people say mutual fund, they're usually talking about actively managed mutual funds. What's the difference? With an index fund, no one is making decisions. The fund just copies an index automatically. With an actively managed mutual fund, you have a professional fund manager or team of managers actively picking stocks. They're researching companies, analyzing trends, trying to find winners and avoid losers. Their goal? To beat the market. Sounds good, right? But here's the problem. Most actively managed funds fail to beat the market over the long term. Studies show about 80% of active funds underperform their benchmark index over 10 years, and they charge way higher fees for that underperformance. While index funds charge 0.1 to 0.2%, active mutual funds often charge 0.5 to 2% or more. Let's break down mutual funds' features. Like index funds, mutual funds trade once per day at the closing price. They have professional management, which sounds fancy until you realize you're paying high fees for that management. Those fees typically range from 0.5 to 2% annually, compared to 0.03% for many ETFs. That difference compounds over decades and costs you serious money. Most mutual funds also have minimum investments of $1,000 to $3,000, though some require even more. They're also tax inefficient compared to ETFs because of how they're structured. And remember those performance stats. Over 10 years, 80% of active mutual funds failed to beat their benchmark index. Over 15 years, it's 90%. So you're paying higher fees for worse performance. That's why most experts, including Warren Buffett, recommend low-cost index funds or ETFs for the average investor. Finally, let's talk about hedge funds. But honestly, for 99% of people watching this video, hedge funds are completely irrelevant because you can't access them anyway. Hedge funds are exclusive investment funds for wealthy individuals and institutions only. To invest in most hedge funds, you need to be what's called an accredited investor. That typically means you need a net worth over $1 million or annual income over $200,000, or you need to be a qualified institution. Even if you meet those requirements, most hedge funds have minimum investments of $250,000 to $1 million or more. So yeah, they're not for regular people. What do hedge funds do? They use complex strategies like short selling, leverage, derivatives, and alternative investments to try to generate high returns regardless of market conditions. The name hedge fund comes from the fact they originally hedged against market risk. But here's the kicker. Hedge funds charge insane fees. The typical structure is 2 and 20. That means 2% annual management fee plus 20% of any profits. So if the fund makes 10%, they keep 2% of your total investment as a management fee plus 20% of that 10% gain. The fees are brutal. And despite these high fees and supposed expertise, most hedge funds also failed to beat the S&P 500 over the long term. Unless you're super wealthy, forget about hedge funds. They're not accessible and they're not necessary. Let me be clear about who hedge funds are really for. The 1%. Ultra-wealthy individuals with millions to invest who are looking for alternative strategies and exotic returns beyond traditional stocks and bonds. That's the target client. The 99%? That's you and me. Regular investors trying to build wealth over time with our paychecks and savings. And guess what? We don't need hedge funds. We can't access them, and even if we could, we wouldn't want to pay those fees. What should you use instead? Low-cost ETFs with fees around 0.03%, index funds with fees around 0.1%, simple, accessible, proven strategies that actually work. Save the hedge fund dreams for if you become a multimillionaire. Until then, stick with what's accessible and effective.
All right, let's put it all together in one comparison table so you can see everything side by side. Index funds trade once per day, fees around 0.1%, passive management tracking an index, minimum investment usually $1,000 to $3,000, accessible to anyone.
good tax efficiency, best for people with larger lump sums to invest. ETFs trade anytime during market hours, fees around 0.03%, usually passive management. Minimum investment is just the price of one share, so $50 to $500, very accessible to anyone. Excellent tax efficiency, best for most investors. That's why it gets the crown. Mutual funds trade once daily, fees 0.5 to 2% or more, active management trying to pick winners, minimums $1,000 to $3,000, accessible to anyone, poor tax efficiency, best for specific situations but generally not recommended. Hedge funds, trading varies and is limited, fees are 2% plus 20% of profits, very active, complex strategies, minimum investment $250,000 to $1 million or more, only accessible to wealthy accredited investors, tax efficiency varies, best for ultra-wealthy people. Looking at this table, the winner for most beginners is clear. ETFs. Lower fees than everything else, easy to access, flexible trading, excellent tax efficiency. That's where you should start. All right, let's wrap this up. We covered 4 types of funds today. Index funds, which passively track a market index, trade once daily, and charge low fees. ETFs, which also usually track indexes but trade like stocks anytime during market hours, charge the lowest fees and are the most flexible. Mutual funds, which have active managers picking stocks, charge higher fees, trade once daily, and usually underperform the market. And hedge funds, which are exclusive investment vehicles for the ultra-wealthy with massive minimum investments, complex strategies, and huge fees. For 99% of people watching this video, the choice is clear. Start with ETFs. They have the lowest fees, they're accessible with small amounts of money, they're tax efficient, and they're simple to understand and use. That's where your focus should be. Here's your action plan. Open a brokerage account at Fidelity, Vanguard, or Schwab. Search for a low-cost broad market ETF like VOO, SPY, or VTI. Start with whatever amount you can afford, even if it's just $50 to $100. Set up automatic monthly investing to practice dollar-cost averaging, then let compound interest and time do the heavy lifting over decades. That's it. That's the plan. All 4 of these are funds, but ETFs win for most people. If this video finally cleared up the confusion between index funds, ETFs, mutual funds, and hedge funds, please hit that subscribe button and turn on notifications. Every week on the Investing Whiteboard, I break down investing concepts this simply, using real experience from over a decade in the markets. Drop a comment below and tell me, which fund type are you currently using? Are you Team ETF, Team Index Fund, or are you still in actively managed mutual funds? Or maybe you just learned about all of this today. I read every single comment, and I love hearing where you are on your investing journey. Thanks for watching, and remember, keep it simple, keep fees low, and let time do the work. See you in the next one.